Your mind is what makes the difference between great returns and poor returns. A lot more in the asset class that you choose to invest in. Now, we've been discussing a couple of really interesting biases. We've talked about the confirmation bias, the conservatism bias, and a few others. And in today's video, I'm going to talk to you about a couple of very interesting biases that I am pretty sure you've succumbed to at least once in your investing life. And these are known as A, the information overload bias, and B, the recency bias. Have you heard these terms before? Now, I'm pretty sure that you're all familiar with the mountains of information that surround us these days. You've got social media, you've got Instagram, you've got Facebook, you've got Twitter, you've got LinkedIn, you've got your news channels, you've got all your news apps, and all they do is sensationalize. Now, while they have a place, and I'm sure all these sources of information serve their purpose, they certainly are not very, very useful when it comes to your investing life. And I can vouch for that. Now, the information overload bias basically stems from the mistaken belief that more information is always good. But is that the case? Is more information always good? Well, I beg to differ. There are a couple of very, very interesting studies that corroborate the fact that beyond a certain point, information is actually detrimental to decision making. Yes, you heard that right. So while some information is good, a little more may be better, and a little more may be even better, there reaches a tipping point, my friend, when information serves to your detriment. And unfortunately, considering that we're surrounded by information everywhere we look these days, this doesn't bode very well for the information bias when it comes to investing. Just switch on the TV and switch on any news channel or switch on any financial news channel or read a financial newspaper and you'll know what I mean. Headlines sensationalize everything, right? Bloodbath in the Wall Street, investors lose X lakh crores in a day, or investors gain X lakh crores in a day. Now all these are just notional gains and losses, my friends, but what these sensationalized headlines serve to do is they make you believe that the markets are headed here and there and you must react. So I have always said this, biases don't exist independently of each other. You see, biases exist together. Biases feed upon each other. And the information overload bias, for example, will feed the action bias, prompt you to do something with your portfolio when you maybe shouldn't have, and there you go. It's very soon devolves into a jumbled up mess. Now, a couple of videos back, I spoke about something known as the confirmatory bias, right? And that's the bias which naturally makes us seek out information which agrees with our point of view. That's what we do. Fortunately, or rather unfortunately, today in the form of Google, there exists an information source which will serve to fuel your existing beliefs. Google point of view A, and you'll get 20 different web pages corroborating it. Google the exact opposite viewpoint, and yes, voila! You have 20 different websites corroborating that too. So understand for a moment how the information bias and the confirmatory bias work together to your detriment. A, you've got a lot of information out there. Second, you're more prone to seeking out information that agrees with your point of view. And before you know it, you've created a viewpoint which may or may not be accurate, and you've got mountains of sometimes irrelevant information supporting that viewpoint too. My advice is be passive. Personally, I don't like to look at news channels during market hours or read every single headline or read sensationalized headlines. I like to rather imagine a more commonsensical framework, a more Buffett-esque framework of investing would work a lot better. For example, when Warren Buffett was asked, what's your investing framework, what's your investing methodology, he didn't say, I trawl through mountains of information and balance sheets and this and that and blah, blah, blah. He said, I pick great companies at decent valuations, I look for a great product, I look for great management, and then I just back off and kind of let the markets do their work. See how simple that is. And I'm sure if Warren Buffett sought out mountains of information before making every single investment decision, either he'd have analysis paralysis and never invest at all, or he would be jumping around in and out of equity stocks as if he's prancing on hot coals, and he'd never be the wealthy billionaire that he is today. So I would say be very, very careful about the information that you allow into your brain, that you allow into your psyche, that you allow into your environment. Yes, I'm not saying you should live under a rock. Be aware of what's happening around you. Keep yourself fluid into what's happening around you, but be careful of succumbing to the information overload. Trust credible sources of information, but in the end, remember, it's your own judgment that's going to set you apart. Let's briefly touch upon an example of how, for example, the information overload bias could work against a mutual fund investor. Very, very briefly. Now, I know mutual fund investors who trawl through every single website, speak to 150 different advisors, and in the end, they have so much information, but nothing else. They don't invest properly. They try and time the market. They try and get in and out at just the right time. And in the end, they end up either becoming fence sitters or they end up catching the bull market at the very fag end and having poor experiences and then wondering, hey, the published returns are so great. Why have I not earned great returns from this mutual fund? Well, my friend, that's because you sought out way too much information. All you need to know is the fund's pedigree, the fund manager's pedigree, how well has it fared during the really, really bad market cycles, and is it true to label or not? Is it a good fund? Does it have a philosophy in place? I guess that's about it. Don't seek out Alpha, Beta, Sharp, Renner, Jensen, Sortino, etc., etc. That's just going to turn you into a quivering mess and a completely indecisive investor. So stick to the basics. Of course, be clued on, but understand that too much information can also work to your detriment. Now that we've spent some time understanding how the information bias plays out in our investing lives, I'm going to now touch upon a very, very interesting phenomenon known as the recency bias or the recency effect in very, very simple terms. Now, the human mind is so programmed, unfortunately, to attach a lot higher significance to information, news, events that are recent. And I'll give you a very, very classic example of the same. When most investors who invest through a DIY or do-it-yourself route decide to invest in a stock or a mutual fund, what do you think is the first metric that they look at? Any guesses? They look at 3 or 6 or 9 month return. Now, if I may say, that is probably the worst metric to look at while investing, right? Because, for example, if something goes down, it's bound to go up. Or if something goes up very sharply, it's going to come down. That's just the rule of how financial markets operate. That's the rule of mean reversion, my friends. No asset class goes up forever. So if you're going to look at recent bits of information, recent past returns, ultimately what you're doing is, my friends, you're getting into an asset class after it's already gone up, or you're selling out or avoiding an asset class when it's gone down, when it's cheap and probably ripe for an increase. So do you realize now how the recency effect may work against you? Very similarly, this is what happens when markets start falling or any asset class starts tumbling, the way it did, for example, during COVID last year. There was a bloodbath, right? Everything was tumbling. I met clients who said, brother, don't invest my money. Nifty is going to go down to 1,000. I said, I'll eat my hat if the Nifty touches 1,000. But hey, my words fell on deaf ears at that point. But anyway, and so because the recent phenomena were also bearish, all the news flows, the sentiment, the headlines, everything was so bearish, so negative. People were just not able to move past that and read between the lines and understand that, hey, there are paradigm shifts in the offing. Our trade deficit with China is going to probably get lower. Our gold imports are going to get lower. We're probably going to come out of this quicker than the others because we are a service-oriented economy. All those broad data points were ignored simply because all the recent news flow was extremely negative. So that's what happens. You probably succumb to it at least once in your life. When everything is bearish, you feel very, very bearish. When everything is bullish, when everything is going up, for example, the way it is now, you got the Nifty soaring to astronomical heights, and all of a sudden, everybody is just looking at 1, 2, 3 month returns and saying, hey, this is a great time to get in. This is a great time to get in hook, line, and sinker. Let me sell my house and get into equities. My friends, it doesn't work that way. That's just the recency effect at play. So there you have it, my friends. I hope you found this little talk on information overload and recency biases interesting. I hope you've resonated with it. If this is something you've been doing in your investing life, I suggest introspect, understand that many of these biases may be working against you. Ultimately, I know a lot of people who succumb to biases and a lot of people who don't. There's nothing like awareness to help you become a better investor. So switch off the television, invest based on simple, important little bits of data rather than 1,000 different data points, and move past the recency bias. See the bigger picture. Don't rely on recent information, recent occurrences. Don't extrapolate the last 3 months into the future. It never works that way. And I'm sure you'll be a much better and a much more successful investor if you're able to move past these two biases. Happy investing. Stay well. Cheers. Cheers.